I firmly believe that it's not how much you make, it's how much you keep that matters. Wealth eroding forces constantly serve to take from the inattentive and the unwise. Taxes are second only to misplaced risk as the top wealth eroding force for retirees. As a citizen, taxes are unavoidable. However, reducing and eliminating them legally is not only a right, but it's a responsibility. Here are several issues, I call them landmines, involving taxes in retirement that are worthy for us to examine. Who's heard of the phrase provisional income? It's a tax term. While you were working, you had earned income. In retirement, it's titled provisional income. Provisional income is income from such things as pensions, dividends on stock, capital gains on stock, distributions from mutual funds, interest on bonds, CDs, and savings accounts. Provisional income is income that comes from distributions from your IRAs and 401ks. Most of your income in retirement is classified as provisional income. The more provisional income you receive, the higher your taxes will be. The more deliberate and strategic that you can be in managing the flow of provisional income, the more money you'll save and the better off you'll be. If you don't need it, slow the cash flow or eliminate it by using tax-deferred, tax preference, or tax-free investments such as stocks that are subject to capital gains only at the time of sale, municipal bonds that provide tax-free income, annuities which allow for tax-deferred growth, and Roth IRAs where growth is tax-free forever, best of all worlds. Managing provisional income is key to tax success in retirement. Another issue involving provisional income is Social Security. You may be surprised, even a little bit upset to learn that your Social Security benefits are taxed. They're taxed if you have provisional income beginning at $25,000 for a single person and $32,000 for a couple. And up to 85% of your benefit is subject to tax. Anything that you can do to reduce provisional income and to reduce your tax bracket, the less your Social Security benefit will be taxed. Let's talk a little about a cost affiliated with Medicare, the premiums. This chart reflects Medicare premiums. Medicare premiums are means-based, and they're based on your income for the remainder of your life. The initial premium is calculated based on your adjusted gross income 2 years before you actually start paying premiums. So you have to be careful to avoid increased income in that year if at all possible. A bonus, exercising stock options at age 63 are examples that could lead to higher Medicare premiums in retirement. If you're deliberate with your income timing leading up to retirement and in retirement, you may well be able to reduce your Medicare premiums substantially over your lifetime. Speaking of tax-free investments, let's get back to one of the best, Roth IRA. But I want to talk specifically about Roth IRA conversion. You convert your IRA or 401k to Roth IRA by going ahead and paying the taxes on it now. I say going ahead and paying the taxes now because you have to pay taxes on it sooner or later. There's no way around it. It absolutely is a pay now or pay later situation. Some benefits of Roth conversion are owning a tax-free asset for income flexibility that allows for tax diversification, avoiding required minimum distributions at age 72, minimizing your Medicare premiums, creating a tax-free asset to pass on to your heirs. That's tax-free forever. The power of the conversion is in the tax-free growth. Roth conversion questions to ask yourself are, where will tax rates likely be in the future? What will tax rates be like for me in the future? How much can I convert to maximize my tax bracket before entering into a higher one? And do I have non-IRA cash on hand to pay the tax? Also regarding Roth accounts, if you're still working, you should estimate what your likely brackets will be in retirement to figure out if traditional or Roth IRA contributions make more sense to you now. I'm talking about your uniqueness and your unique identity once again. I want to point out that business owners should consider converting to a Roth, because my experience has been is that business owners, they never really retire. They may slow down working in the business. They may have somebody else to come in and take over for them, but they never really give up the income from the business. And that ongoing income, plus those added required minimum distributions that start at age 72, just push you into a higher tax bracket. So it's definitely to your favor to look at Roth conversion, Mr. Business Owner. If you have company stock in your 401k, you should investigate NUA, which stands for Net Unrealized Appreciation, well in advance before you retire. If done correctly, NUA reduces the tax that you pay when you eventually sell that stock and provides a much more tax-efficient asset for your heirs. I want to warn you, though, you need to talk to someone who knows about NUA and specializes in it. I can help you with that if you need help. So is the old saying, death and taxes are certain, really true? Yes, but in retirement with attention and a little effort, you can have considerable influence over both of them. Do you have sources to help manage your taxes in retirement? $1 saved in taxes is $1 in your pocket. I want to close on taxes by reminding you that it's not so much how much you make as how much you keep that matters. Recapturing lost money to taxes is a great way to grow in this.